Good evening to all of you. Good evening.
Good evening.
Okay, great. Good evening too. See, last time we met, we were discussing on how to get the cost of capital, and we started off by discussing how we can get the cost of equity. And plus the cost of equity, we did say that there are two models we can use to estimate the cost of equity. There are two models we can use to estimate the cost of equity. We have the first model, okay, what we refer to as the dividend growth model, okay, which we say that it is pegged on the fundamental theory of valuation, okay. We also discuss on the capital asset pricing model, okay. We also discuss on the capital asset pricing model, okay. Where you say that as per the capital or the CAPM, the capital asset pricing model, okay, then there are two types of risks that we need to get to know of, okay, which you mentioned, the systematic risk and the unsystematic risk, okay. Those are the two risks that we did mention. And we say that the market is only going to be giving returns, okay, or premiums if your investment, if your stock is exposed to the systematic risk, okay. If you have any unsystematic risk exposure, then there's no return you receive, okay. There's no return that you do receive, okay, in case there's any exposure towards the unsystematic risk, okay. So today I want us to discuss on how we get the cost of debt, okay, on how we get the cost of debt, okay. Now we are going to base our, you're going to base the evaluation of the cost of debt, okay, is also based on the dividend valuation. It's also based on the fundamental theory of valuation. It's also based on the fundamental theory of valuation, okay. We see that the market value, I think we did mention this, so the market value of financial instrument, okay, as per the fundamental theory of valuation, is the sum of the market value of all the interest, the market value of financial instrument is the sum of present value of all the future interest that as a holder you're going to be getting from that particular stock, okay. So it's worth enough return, okay. Therefore, what is the total present value of the interest you get, okay. And in the case of debt, the receipt, the cash flow that you get is therefore going to be therefore the interest only, okay, the interest. And if maybe the case of if the bond is redeemable, then also you'll be getting the redemption value, okay, you also be getting the redemption value. But in case the bond is irredeemable, okay, that means therefore there is no end life, then therefore the market value of such an instrument therefore will be equal to the interest you'll be getting from year 0 to infinity. Then we get the present value back to year 0, okay. Let me get my writing area to illustrate that point, okay. Okay. So based on the fundamental theory of valuation, the market value of the bond, if it is irredeemable, that we knew therefore it doesn't have an end life, irredeemable bonds, okay. Then the market value P naught therefore will be equal to the sum of interest, the sum present value of interest to be received. The sum of present value of interest received, okay, of course, from the first year all the way to infinity. Don't forget it is irredeemable, there's no end life, okay. When you therefore since the interest you'll be getting is fixed, don't forget the interest you'll be receiving as a bond holder is fixed. Therefore, this is therefore can be considered as an annuity, okay, an annuity to infinity. Therefore, the present value of annuity to infinity, okay, that is our page today. Therefore, is the annuity we divide by R, okay, which I think we discussed the last time, okay. Which means therefore the market value of this bond P naught is equal to therefore the interest you get, okay. Which of course therefore if this tax, the net tax, okay, we discount back to year 0 and the cost of debt, okay. We need to get the cost of debt. Therefore, the cost of debt RD therefore is the interest net of tax, 1 minus T, we divide by P naught, the current market value of the bond. And of course, we express this as a percent. And simply, that's what we get for the market value, or we get the cost of the bond, okay? Where, let's put, okay, where P naught is the X interest market value of the bond. Okay, P naught is always on X basis. I think I mentioned that the last time. X interest bond value, market value of the bond, market value of the bond. Okay, RD is the cost of the bond, cost of debt, or the cost of this bond. Okay, and of course, INT is the net interest income. INT 1 minus T is net interest receipt, net interest income. And that is it. Okay, and that's therefore we estimate therefore the cost of the bond. Okay, if the bond is irredeemable, there's no end life. Okay, therefore as a holder, you're going to be getting the interest from year 0 all the way to infinity. From year 0 all the way to infinity. Okay. Now, what if the bond is redeemable? Okay, what if the bond is redeemable? Okay, if the bond is redeemable, okay, because of the case of bond that is irredeemable. Okay, if the bond is redeemable, okay. If the bond is redeemable, that means therefore there is an end life. Okay, maybe this bond is going to have a life of 10 years. Therefore, to me, therefore, at the end of the 10th year, the company is going to be, or this bond is going to be redeemed. Okay, as a holder, you're going to be getting back the initial investment, or as for the agreement, you're going to be getting back your capital as for the agreement you had with the company or the issuer of this bond. Okay, which means therefore, if you remember, when we were discussing on valuation of bonds, we said that the market value of bond that is redeemable P naught, okay, is equal to the interest we're getting, okay, 1 minus T, okay, we multiply by the present value and its factor, okay, R percent, okay, N years, okay, this is the present value of the interest, okay, plus, okay, we get also we need to also discount back to year 0, okay, the redemption value, well, this bond is redeemable. Therefore, just again, we're getting therefore redemption value, okay, redemption value times present value interest factor, okay, N years R percent, okay. Don't forget R percent here, okay, this R percent here is the cost of the debt, okay, is the cost of the debt, okay. Now, how therefore do we get therefore R percent? How do we get this R percent, okay? You're going to be getting the cost of debt, okay. Let me just set it here. Don't forget R here is equal to the cost of debt, okay, cost of debt, okay. Don't forget T is the corporate tax, which occurs the corporate tax rate, okay, which also we had before, okay. We have this formula already. Don't forget, you already have it because we have done a valuation of bond. P naught, I think I've already done it. I don't need to repeat again. P naught, don't forget, is X interest market value, yes, yeah, and N is number of years to redemption. N is equal to number of years to redemption. Number of years, or number of periods, actually, not even years, number of periods to redemption. Let me use the correct terms. Number of periods to redemption. But of course, in most cases, the periods will be years. Number of periods to redemption. Okay, so that's kind of for so therefore the question therefore what we want to determine therefore is how therefore do we get the R percent? Okay, we use trial and error method. Okay, you're going to be using the use of to estimate. Let's make a note here to estimate the cost of debt. To estimate the cost of debt. The cost of debt. Okay, we shall use the trial and error method. The trial and error method. In the method we refer to as the Irr formula, the Irr method. Okay, you're going to be using the trial and error method, the trial and error method, or the so-called the internal rate of return method, which I think we have discussed when we were discussing the valuation of, we're discussing how to get the different appraisal method of a project. Okay, so we did discuss on the Irr method. Either way, let's discuss it now. So as mentioned, we're going to be using trial and error method. What we do is that we determine, okay, we make an estimation, okay, just like we did with the Irr method at a project appraisal, okay, And the same steps shall be used in here. Okay. The idea is that we want to estimate what is going to be the discount rate. Okay, what is going to be the discount rate, that once we discount the interest and the redemption value, it is going to give us the sum of these two, to be equal to the current market value of the bond. Okay. If, for example, out of a trial, this is a trial and error method. If, for example, we discount these cash flows, the interest and redemption value, at let's say 8%. Okay, just an example. Okay, if the current market value of the bond, market value of the bond, okay, is let's say 105. Okay, if we discount the interest and the redemption value, and we get the sum, we call the sum here to be equal to let's say 103, and therefore we do need to and we did discount the cash flows, for example, at let's say 10%, and the sum present value was 103, then of course, therefore, we need to use a second discount rate. We need to increase the present value of the present value of the cash flows, okay, because they are 103. We need to increase them to 105, for example. We decrease this discount rate from 10, for example, to let's say 8%. Okay, we get, for example, let's say 107. Okay, which means therefore, if we discount the cash flow at 8%, we get the sum of those present value. The sum of present value equal to 107. It means therefore our discount rate is between our IRR is between 10% and 8%. Okay, I really hope that this is not something strange to you. Okay, you know this. You have done this already. I think therefore we can therefore case this the cost of this debt, the cost of debt of this company, of this bond, is between 8 and 10, because therefore it is minimum is 8%. Okay, plus the difference 10 minus 8, which is 2%. Okay, the value of, in quote, the NPV at 8%. Okay, we got at 8%, we got the lower discount rate, we got 107. So the NPV is 2. Okay, because it's 107 minus 105, and therefore we got 2 divided by 2 minus 2. Okay, because this is at here, the sum is the difference between 105 and 103 is negative 2. The difference between 107 and 105 is positive 2. Okay, therefore this gives therefore 9%. Okay, and that's, okay, this is the IRR formula. Okay, that I've used here. If you remember, we said IRR formula is equal to, the R is equal to the lower discount rate A plus the difference between the higher discount rate minus the lower discount rate, the value at the lower discount rate, NPV A divided by NPV A minus NPV at the higher discount rate. This formula, we have done it before, so I really hope that it is not any strange to you. Okay, and that's how therefore we get the cost of debt, but if this bond is redeemable. Okay, if this bond is redeemable. Okay, that's how therefore get the cost of the discount rate. Okay. Clear? Question? Okay, no question. Fair enough. Let's do therefore an example. Okay. Okay, so go through this example, then we attempt to do it together. Yeah, in this example, we've been asked to get the cost of debt if the bond was to be irredeemable, and the cost of debt if the bond was to be redeemed in year 5 and in year 10. Okay. Let me get this kind of question. Okay, so if the bond was to be irredeemable, because so in this case there's tax, which means therefore the net interest income, therefore will be equal to 10%. The interest rate is 10% times the nominal value, which is 100. Then you do pay you don't get all the interest income. You get that percent. Okay, 1 minus 0.3, you get 70%. Sorry. Okay. Let's give therefore $7 to be therefore the net interest income. If the bond is irredeemable, then the cost of debt therefore will be equal to the net interest income, okay, divided by the current market value P naught, and we express this as a percent. which is equal to 7. Therefore, we divide the current market value, which is 95, okay, and we express as a percent to give us how much? 8 point, 7 point, I don't know.
7.37.
7.37, okay, therefore the cost of this bond 7.37. Okay, 7.37, therefore come therefore the cost of this bond. Okay, simple as that. That is in case this bond was to be irredeemable. Okay, clear? Okay, great. That's how we get the cost of the bond if it is irredeemable. Now, what if the bond is? Yes.
I'm sorry, I joined a bit late. Please, can I see the formula for a minute?
Okay.
Please.
Formula. Okay, this is the formula. Where is it? Yes, this is the formula.
Thank you.
Okay, that's together for the cost of the bond if it is to be irredeemable. Now, what if the bond is redeemable? Okay, for example, if the bond is going to be redeemed at year 5, if the redemption occurs at year 5, for instance, then you can say therefore, the current market value P naught, which is 95, therefore P naught is, as we mentioned, P naught, the current market value, has given us the interest we received times present value and factor. Okay, these are 5 years. 5 years are percent. Okay, plus the redemption value, we just come back to a 0 present value interest factor. 5 years are percent. Okay, P naught is 95. Therefore, 95 is equal to the interest, which you have seen to be 7 times present value interest annuity factor. 5 years are percent. Okay, plus the redemption value, which is therefore redemption value times present value. Redemption value is in this case, you don't know that what to be the redemption value. But of course, as we say, the common assumption is that we're going to redeem the bond at its par value. In this case, the par value is 100 because the question in quotes is silent. Okay, it will be 100 times present value interest factor. Okay, 5 years R percent. Therefore, there is trial and error method. Okay, there is a trial and error method. Okay. For instance, if we discount these cash flows, okay, the interest here and redemption value at let's say 10%, what comes of the sum of the present value? Okay, it will be equal to, this is a trial, don't forget, it's a trial and error method at 10%. Let me discount at 10%. It will be equal to, so if for instance we were to if the cost of if the R percent here, if the cost of debt is 10%, then as we mentioned, the sum of present value, okay, these two, okay, ought to give us 95. Okay, the sum ought to give us 95, which means the difference will be equal to 0. Okay, well, imply therefore, we can see therefore that the difference when you can get the difference between the right hand and the left hand side, okay, the left and the right, the difference ought to be equal to 0. Okay, therefore I'm going to take 0, therefore can say to be equal to, okay, before I do a 10% for distance, you can say therefore the difference should be equal to 0, it should be equal to negative 95, okay, which I'm subtracting from the sum, plus $7 times present value and its factor, 5 years R percent, plus 100 times present value interest factor, okay, 5 years R percent. Okay, that is the case, the discount rate. Once we discount, if the R percent is the correct discount rate, the cost of debt, then the difference will be equal to 0. Okay, therefore, the first trial, let's do a 10%, the first trial, and this will be equal to negative 95 plus 7 times present value and its factor, 5 years, 10%, the first trial, okay, plus 100 times present value and its factor, 5 years. So this is interest factor because redemption occurs only once. this is still cash flow, 5 years, 7%. Okay, if 7% is a cost of debt, if 7% is the cost of this bond, then of course we need to get a difference of 0. This should be a 0, but we are not sure. So let me just remove it because we are not sure the 7% is the correct discount rate. It's a trial. Okay, but let's get, what do you get therefore to be the difference to be the sum of this present value, to the sum of the present value, okay, to be the sum of our equation here. Okay, if we discount the cash flows at 7%, what do you get?
I'm getting 5.
Let's say 5.
Yes.
Okay, someone to confirm.
It's true.
Okay, good to get 5 to be therefore be the sum of present value, which means therefore the 7% is therefore not the cost of this debt. Okay, why? Because we ought to have gotten a 0. Okay, like you have mentioned here, you meant to get a 0, which you didn't get. Okay, which means therefore 7% is not the cost of this bond. Okay, now therefore let's do a second trial. Okay, let's say at 8%. Okay, at 8%, same process, but now at 8%. Okay, at 8%. The sum will be equal to -95. Okay, the same process, plus 7%, $7 present value and factor. Okay, 5 years, 8%, plus 100 times present value interest factor. 5 years, 8%. What do you get in case we discount the same cash flows, but now at 8%?
1.
Positive 1.
Yes.
Exactly 1.
1.0089.
Okay. So you get positive 1. Someone confirm that value?
Yes, it's true.
Okay, fair enough. Therefore, based on we can now, since we do have these two values, okay, the value at 10%, the value at 8%, then you can use the IRR formula to estimate, okay, what should be the cost of this bond, okay. So therefore, based on the IRR, just to remind you, the IRR formula, A plus B minus A, the value at A, that is at the lower discount rate, the lower discount rate, the value at the higher discount rate, okay. Therefore, the cost of this debt, therefore, you can see A, which is 10%, plus the difference, which is 1%. The value at A at 10%, we got 5. Therefore, 5 minus 1. Okay, because 1 is therefore the value at the higher discount rate, or NPV in quotes, NPVB. Therefore, we get 8 points to be the cost of the debt.
$8.25.
And get 8.25%. Someone confirm?
Yes.
Okay, again, therefore 8.25, therefore to be the cost of this bond, 8.25. Okay, and that's what therefore we estimate therefore the cost of the bond. Okay, if this bond is redeemable. Okay, now how would we get to okay, one of the ways that can try to reduce the number of trials that you do make, okay, is simply to determine what will be the cost of this bond, what will be the cost of this bond if it was to be irredeemable. Okay, if you're saying I did pick 7% here, okay, my first date here I used was 7%. Okay, why did I pick 7%? Because the cost of the bond, of the same bond, if it was to be irredeemable, was 7.37. Okay, which means therefore the cost of the bond, if it was to be redeemable, will not be too far off from the cost of the same bond if it was to be redeemable. Okay, that's therefore you estimate therefore where is the cost of this bond. Okay, if it was to be redeemable, you simply determine what will be the cost of this bond if it was to be irredeemable. Okay, and the cost of the same bond, if it was going to be irredeemable, will not be too far off from the 7.37%. That's why I chose my first trial 7%. Okay, is that clear? It's just a hint. You can try any other rate. Okay, 8, 9, 10. Okay, however, your answer is going to be closer to the correct discount rate, the correct cost of debt. Okay, if you reduce the number of attempts. Okay, with your answer close together as possible. Okay, is that clear? I hope it's clear. Okay, that generally, okay, the cost of the bond, if it's going to be redeemable, it will be close to the cost of the same bond if it's to be redeemable. And of course, it's easier to get the cost of the bond if it is redeemable, because simply the interest you divide market value, like we saw in in part A. Okay. Now, can you do part B? Okay, do part B. Where now the only difference here is that in part B, the redemption is not occurring in year 5. Redemption is occurring in year 10. Okay, redemption is occurring in year 10. Can you get the cost of the bond? Okay, cost of the bond is redemption. Okay, cost. Okay, that is R, the cost of the debt. Okay, if number of years redemption is 10 years. Okay, take 2 minutes, try it out, then you come together, give me the answer. Okay, the same bond. Okay, and now as Roman 2, where now the number of years to redemption, the maturity is 10 years from now. What will be the cost of the bond?
9952.
So 5 more or less, isn't it?
Yes.
Okay, so get 5. Okay. At 8%, Mary, you did use 8% as your next discount.
Yeah.
Okay.
Yes.
Is equal to negative 95 plus 7 times present value factor, 10 years, 8% this time around, okay, plus redemption value, present value of redemption value, present value interest factor, 10 years, 8%, and you got?
Negative 1.71.
71, okay, negative 1.71, okay. Which means therefore the cost of this bond is between 7 and 8% because don't forget our intention was to get a sum of 0, but you can see it between and 0 is between 5 and negative 1.71. Therefore, the cost of this debt using the IRR formula therefore could be equal to 7% plus the difference, which is 8 minus 7, which is 1%. The value at 7%, we got 5. Okay. We divide by 5 minus 1.71. This give us 10 point.
$7.745. 7.745. Excuse me, sir.
Yes, Mary.
I'm getting 7.745.
7.745. That way, more than 7.75.
Yes.
Okay, great. And that's together for the cost of the debt. Okay, 7.75%. Okay. Any questions so far? Okay, no question. Now, what if now we have a bond that is convertible? Okay, what if you want to get the cost of a bond? However, this bond is convertible. What or how would you get the cost? If the bond is convertible, okay, convertible bond, okay, it would be equal to, don't forget here, if you remember when we were discussing on how to get the market value of a bond that is convertible, we see the market value of the bond, P naught, will be equal to the interest you'll be getting, okay? The interest to get the present value, the market value of the bond will be equal to interest times present value and factor, n number of years to conversion, okay, R%. In the final year, don't forget you can either redeem or convert, okay? Redemption value or conversion value, whichever is greater. Okay, I think we did discuss all this. Times present value, okay? Present value, interest factor, okay? N years R%, okay? N years R%, okay? So either conversion or redemption, whichever is going to be greater. So the same process we have done with how to get the cost of the bond. If it is redeemable, the same process I will be applying here. So the only difference that in the final year, what are you going to do? Okay, do we redeem or do we convert? Okay, don't forget to determine whether to convert or redeem is simply based on the investor. Okay, wanting to get more value, which therefore we're going to in the final year we are going either to convert or redeem based on which of the two options grant us more wealth. Okay, grant the investor more wealth. Okay, as we did discuss when we were discussing on how to get the market value of a bond that is convertible. Okay, that's the only difference. Okay, between getting the cost of the bond if it is going to be redeemable and the cost of the bond if it is going to be convertible. Okay, so in the final year you have to determine should we convert or should we redeem, and it's the option to take should be the one that grants you more wealth. Okay, but the process is the same, the use of trial and error method. Okay, great. So let's do an example, a case where if the bond is convertible. Okay, the bond is convertible. Okay, so let's go back to our notes. So we have it here, but let me. Okay, let me change something here. From 85 to 95. From 85 to 95, the market value to be at 95. Okay, but all the other variables remain the same. Okay. Okay, estimate the cost. Mwangi, what do you have from your end?
I got stuck in the middle, so I've not finished.
You got stuck where? Sorry.
Like I wasn't sure which value to use, like in the second part when calculating.
Okay. Sophia, what do you have? Sophia.
I didn't manage to calculate it.
Hey, what happened? Okay, so the fifth year, you can either convert or redeem. The redemption value, okay, between is equal to, it can be at 5% premium in 5 years' time. So 105% of the par value, okay, which is 100, give therefore $105. You can either convert the bond, which the conversion value is conversion ratio times the share price, the time of conversion, that is 5 years from now. The conversion ratio is the number of shares you get per bond. And you do that for every bond you convert, you do get 20 shares. The current market value of share is 4, and the share price will be growing by 7% per year for the next 5 years, 1.07 to the power of 5. Okay. Therefore, the conversion value
112.2.
112.2. 112.2 for the conversion value. And of course, the holder, you make a decision, should we convert or should we redeem? As you can see, conversion value is greater. The holder, the bond will be converted. See the conversion value, since the conversion value is greater than redemption value. Therefore, the market value of this bond, P naught, to be equal to the interest you'll be getting. Let me get the interest receipt. The holder you'll be getting for the next 5 years. The bond pays at a rate of it pays at a rate of 8% per annum. 8% per annum for 8% times its nominal value of 100. Then you do pay tax at that percent. Therefore, the net interest income therefore will be equal to 5.6 for the next 5 years. Therefore, the market value P naught is equal to 5.6 times present value and it factor 5 years R%. Final year, convert or redeem the bond. You said convert the bond, therefore you get 112.2 times present value interest factor 5 years R%. If the P naught is equal to actually 95, so okay, I can replace this P naught to be the 95. Therefore, 95, not 80. Therefore, 95 is equal to the sum of those present value. Therefore, try another method, okay? Try another method. Don't forget, as I mentioned, as a side working, you can determine what would be the cost of this bond if it was to be irredeemable. It would be equal to 5.6, the interest, we divide market value, 95, to give us, if this bond was to be irredeemable, what would be its cost of debt? Would be the interest divided market value. Interest 5.6, market value 95, to give us how much in percent?
$5.89.
5.89. So therefore, the cost of this bond will not be too far from 6% anyway. So don't forget, you don't need to do this working. This working is just to guide you to know where the cost of the bond will be. Okay, so you don't need to do this working. Okay, you can do it as I don't know, while you are side working somewhere. Okay, just to know where the cost of this bond will be. Okay, so let's begin at 6%. Therefore, we begin at 6%, and 6% is equal to negative 95 plus 5.6 times present value and factor 5 years, okay, 6% plus the conversion value, present value times present value interest factor, 5 years, 6%. Okay, and you get how much to be the sum?
I'm getting 12.44.
12.44. Okay. Let me just put these figures. Don't forget, as one of you are saying, the tables, the present value tables are online. You can get them. So you don't have to not do the question because you don't have the tables. Anyway, so 5 years, I'm getting 0.747. Sorry, maybe you're getting what? The sum? 5.44.
12.44.
12.44. Positive, negative?
Positive.
Positive. Someone confirm that value.
It's right.
Okay, great. Then we can, don't forget this is a positive, so we can increase the discount rate. Let's say, for instance, to 7%, for example. Okay, at 7%, same process. Negative 95 plus 5.6 times present value, and it factor 5 years 7%. So it's a trial, okay? So you can use 8%, but anyway, I want to have my discount rate as close as possible together. 112.2 times, okay, present value interest factor, okay, 5 years 7%. Be equal to negative 95, 5.6 times you get how much?
$7.95.
Positive 7.96.
96.
So I want to confirm that value.
Yes, it's
It's
correct.
correct.
It's true.
Okay, great. Therefore, since we have the two discount rate,
Correct.
okay, great. We can therefore use our IRR formula to get the cost of the debt. It will be equal to 7%, 6%, 6% plus the difference, which is 1%. The value of 6% we got was 12.44 divided by 12.44 minus 7.96. Give us how much?
$8.78.
8.78%. Confirm.
It's correct.
Okay, therefore we get the cost of this bond to be equal to 8.78% with the cost of the bond. Okay, and that's what therefore we estimate the cost of the bond. Okay, the cost of bond that is convertible, cost of bond that is redeemable, and the cost of the bond that is irredeemable. Okay, and I think we have done all that. Okay. Now, what if you have a bank loan? Okay, how do you have the cost of a bank loan? The next question, the cost of a bank loan. Okay, cost of bank loan. Now, don't forget, the case of the cost of the case of a bank loan, there's no redemption, there's no conversion, there's no trading. Okay, there's a bank loan, so there's no trading that occurs in the case of the bank loan, which means therefore the only cost you be when it comes to the estimation of the cost of the bank loan, okay, there is only the interest you're paying. Okay, it's only the interest you're paying, the counter for your cost, because there's no market value, there's no conversion, there's no redemption. Okay. Therefore, your cost as a company, therefore, is the interest you do pay to the bank of the loan the bank has access to you. Therefore, the cost, therefore, the bank loan, okay, be equal to the interest you pay to the bank, okay, of course, net of the tax that attracts on the interest you do pay. That's therefore the cost of the bank loan. Simple as that. The interest you pay, of course, therefore, that percent, don't forget, is a tax saving. 30% of the interest you're paying is a tax saving. There's a tax shield. Therefore, your net cost is the interest minus the interest tax saving, which is 30%, for example, of the interest that you do pay. Simple as that. So therefore, you determine therefore the cost of the bank loan. Clear? Okay. So you do an example. So that's straightforward, by the way. Okay. So take a minute to go through this. Okay, so in this example, okay, we do that we need to get the cost of the debt, okay, to be equal to, you're paying an interest of 11% per annum, but as I mentioned, don't forget that percent of it is a saving. Therefore, your net cost, therefore, will be equal to 11% times 1 minus 0.3, you have a cost equal to 7.7% to be the cost of this bank loan. Okay, simple as that. Now, in case we do have, don't forget, the company can also obtain finances from preference shares. Okay, the company can also obtain finance from preference shares. So we may want to quantify the cost of preference share. Okay, let's do that. We quantify the cost of preference share. Okay, cost of preference shares. As we mentioned that at the end of the day, don't forget the preference share, okay, they are tradable, okay, these are tradable instruments, okay, and we assume, okay, preference shares, they're tradable, and at the same time, they're also irredeemable, okay, the assumption you get to make, okay, preference shares, okay, they're tradable in the open market, they're tradable, and, okay, they are irredeemable, okay, and they are irredeemable. The preferred dividend, okay, the preference dividend that these preference shares pay, okay, the preferred dividend is also fixed, okay. The preference dividend is fixed, okay. It's not like the case of equity share where the dividend is not fixed, but in the case of preference share, they do pay fixed dividend, okay. Well, the imply therefore, since they are irredeemable and the dividend is fixed, because therefore, okay, the market value of the preference share is equal to therefore the dividend that the company pays or the holders do get, okay, we discount them back to a zero at the cost of preference shares, okay. Don't forget they are fixed and non-taxable, okay, and non-taxable. Therefore, there is no any tax savings, okay. Don't forget, unlike the case of the interest where there is tax savings, but in this case, they're not taxable, which means therefore there is no any tax savings. Therefore, the cost of preference share, therefore, will be equal to the preferred dividend. We call them DP, preferred dividend. We divide by the current market value of those preference shares, okay, where, okay, DP here, okay, is equal to the preferred or the preference dividend, okay. RP is the cost of preference shares, and of course P naught is X dividend, market value, dividend preference shares, market price, MPS. Simple that. That's what we get the cost of preference shares. Okay, we get the cost of preference share. We do an example. Okay, we do an example. Is it? Okay, get the cost. $2.15%. Therefore, the cost of this preference share 2.15%. Okay. Clear? Question? Okay, no question. Now, having obtained or determined, determine the cost of capital from all the different providers, from equity shareholders, debt holders, private shareholders, the next bit, of course, is to get determined, therefore, on average basis, okay, this different provider of capital, how much return, what's the cost to the company, to the entire company, okay, if in quote we combine, okay, from all the different providers, okay, we determine on average basis, how much is the total amount that the different providers are expecting, including shareholders, debt holders, private shareholders, okay, that's the next bit, therefore, okay. Therefore, we do need to get we do need to get weighted average cost of capital. Okay, let's do that to the next tracking. How to get weighted average cost of capital from the different provider of capital. Okay, so the next thing is weighted average cost of capital. It's called WACC. Okay, sometimes that's the mnemonic is used. Okay. Now, as I mentioned, first is determine where the money is coming from. So the first step is determining who are the different providers of capital. So the first thing is determine the capital sources, the source of capital or capital, okay, sources. Okay. Having done that, I think we've mentioned, okay, having first determine where is the company obtains capital from: debt holders, equity shareholders, private shareholders. Once you've done that, you estimate the cost of capital, like you just done, okay? Estimate the cost of capital from each of the capital sources, the cost of capital from each source, like we've just done. If the companies has obtained money from debt holders, get the cost of debt. If from private shareholders, get the cost of private share, private shares. If the company has obtained money from debt holders, then from equity shareholders, then get the cost of equity. Okay, so the next step, therefore, last step, therefore, is to get the weight. Okay, determine or calculate, actually, not determine. Okay, calculate the market weight of each capital source. Okay, calculate the market weights of each capital source. Okay, by that would mean that if the company has obtained money from equity capital, get the market weight of that capital equity source. Okay, for instance, let's give you an example. Okay, for instance, for instance, if the company, the company has obtained equity capital, the market value of equity will be, okay, the market value will be equal, therefore, the number of shares. First is to get how many shares does this company has, number of equity shares the company has issued, equity shares, time of course, the market price per share, that they have given, therefore, the market value of equity shares. Okay, the weight, therefore, in that sense, okay, the weight, therefore, the market weight, we call it the market weight of equity, that will be equal to market value of equity as we obtain here above here, because this is, we divide by the market value of all sources, of all capital sources. Therefore, the weight of the market value. Okay, so you do that for equity, do that for debt, do that for private shares. Okay, so get the weight for each of the capital source. Okay, so this is just an example how to get the market value, the market weight. Okay, of the the market weight of the equity. Okay, in the market value of equity, we divide market value from all capital sources. Therefore, you get the market weight of private shares. Okay, get the market weight of debts. Okay, therefore, once you've done that, you've obtained the market weights. Okay, from each of the capital source. Okay, the next step is to therefore determine the weighted average cost of capital. The last step is to get the weighted average cost of capital, which will be equal to okay, having done that, we need to get therefore the weighted average cost of capital, which will be equal to the cost of equity, RA, times the market times its weight. Okay, weight of equity plus. Okay, I'm assuming the company. Let me see if we assuming the company is financed by debt and equity only. Assuming the capital sources, okay, is made of only debt and equity. So it'll be equal to cost of equity times weight of equity plus cost of debt times weight of debt. Okay, or can be equal to cost of equity times the market value of equity plus cost of debt times the market value of debt. We divide by the total market value of both the debt and equity. Okay, either way, you get the same answer. Okay. Okay, we know what's okay. Let me just put where RE is cost of equity, RD is equal to cost of debt. Log in case it's previous year, then of course just add plus previous year. Okay, if it's previous year plus previous year's year. Okay. Then this weight, this is equal to weight, market weight. Okay, weight of equity. This is weight of debt with debt capital source. And what is all market? This is market value debt, market value of debt, and this is the market value of equity. Okay, and that's what we get there for the cost of weighted average cost of capital for the entire firm. Okay, all the way from getting determine the cost of capital, estimate the cost of capital from each source. Okay, get the market weight. Okay, then once you have the market weight, you simply multiply the cost of the source. You multiply the cost of that capital source times its weight plus all the other source of finance. Okay, their weight times their cost. Okay, we add them all together and get the company weighted average cost of capital. So generally we use the market value. Okay, when it comes to getting the weights, we normally use the market value as opposed to the use of the book values. Okay, why? Because the market value reflects the current status. Okay, book value will be reflecting, okay, when that particular finance source was issued. If, for example, you want to get the cost of capital, the weighted average cost of capital of Safaricom, if you use the book value of equity, it means you're going to be using the book value as per the year 2008, okay, which is quite historical. Okay, however, the market value gives us the value as per today. Okay, the weight of the contribution of each source of each capital source towards the company entire cost of capital. So we prefer to use the book value as opposed to the use of the market. We use the market value as opposed to the use of the book values. Okay. Great, and that's what therefore get therefore weighted average cost of capital for the firm. Clear? Question?
Please scroll down.
There or a bit further?
Yeah, a bit further. Okay. Yeah.
Okay.
Thank you.
Okay, let's do an example. Okay, so go through this, then we discuss together. Okay, let's do it together. So in this example, you've been given the cost of each of the financials. For this company, it has loan notes, that these are bonds. Okay, it has present shares. Okay, it also has ordinary shares, that is equity. Okay, so it has three finance sources. Okay, so we need to get first is to determine, which you have done, determine the financials, get the cost, which is given to us. The cost of note is 9%. Okay, the cost of private share 12%. The cost of equity 18%. So step number 2 is done. Step 3 is to get the weight, which we need to do. Therefore, we first get the market value from each source. The market value. We begin by getting the market value of the notes. Okay, the loan notes, which is equal to. Let me just get clean area to write on. Okay, so we get the market weight. So market value of the notes. This company has initial notes worth with a nominal value of 1 million. Okay, so it's 1 million note, and the nominal value per note is 100. Okay, so we divide by 100 to get the number of notes issued times its market value. DB2 is equal to 50 times 50. Let's give therefore 500,000 worth with notes worth 500,000 in terms of their market value. Next, we get the market value of present shares. The market value of present shares of the company equal to the company. The nominal value of present share is 625,000. The nominal value per present share is 1, and the market value per present share is 40 cents. Therefore, times 0.4. And this gives us how much? 250,000. Then we get the market value of ordinary shares, that is equity, is equal to the number of equity shares, which are 5 million, times the market value per equity share, 25 cents, 0.25, to give therefore 1,250,000. Total market value of the three capital sources is equal to therefore 2 million. Next, lastly, we get with average cost of capital. With average cost of capital, the market value of the notes we have obtained because 0.5 million, 0.5 million times the cost of the notes. Okay, let me just give the formula first. Okay, the cost of the notes, cost of debt times the market value of the debt plus cost of preference share times the market value of preference shares plus the cost of equity times the market value of equity. We divide by the total market value of the three finance sources or three capital sources: debt, equity, and preference shares. Therefore, this will be equal to cost of debt we obtain to be equal to, as given by the question, is 9%. The market value of debt, which obtained to be equal to 500,000, 0.5 million. Cost of preference share, okay, which as per the question is 12% times, 12%. 12% times the market value preference share, 250,000, 0.25 million. Cost of equity, given as per the question, 18%, times the market value of equity, 1.25 million, divided by the total market value from three sources, which is 2 million. To give us how much?
0.15.
0.15, 50%.
Yes.
Exactly 50%. Exactly.
Yes.
Okay, 15%. Confirm.
Yes, it's correct.
Okay, therefore, get the cost of capital for this farm to be equal to 15% on average basis. Okay, from the three provider of capital, don't forget they charge different finance costs. Okay, they charge 9%, 12%, 18%. But on average, the cost of the company is equal to 15%. And that's how you get therefore weighted average cost of capital for the farm. First step, determine where the money is coming from. The capital sources. They're coming from private share, as we mentioned, from notes, private share, and equity. Next step, get the cost from each of them, which is in this example given to us already, 9%, 12%, and 18%. Next step, get the weight, okay? Half a million to 50 and 1.5 million. That step, get therefore weighted average cost of capital. Clear? Question? Okay. And that's therefore we can end our class there. The next time we meet, we shall go to the examiner. We see how has the examiner been testing from this particular area. Okay, so it's going to be tested, evaluating. Okay, the question that the examiner has tested and how or the trick the examiner do use here and there. Any question before we get the class? Okay, no question. Then fair enough, I suppose that all of you are able to get the concepts and get them well. Fair enough, then see you on Monday next week. Enjoy your evening. Don't forget to sign.